Welcome everybody to Wise Tech for Wise Money, the podcast where we speak with industry leaders, founders and investors about how technology, strategy and experience come together to build stronger businesses. I'm Gary Wayne, founder of A1 Solutions, where we help companies grow more intelligently through better strategy, better use of technology, practical AI-driven automation. Today's episode is titled The 20 Million Blind Spot, Why Successful Entrepreneurs Still Have $1 million Tax Problems. I'm joined today by Michael Iskra, who is Managing Director of POM Unlimited, specialising in financial advisory for high-income business owners with complex tax and wealth challenges. He helps clients structure, protect and grow their wealth through coordinated family office style planning. Today we're diving into a topic that many successful entrepreneurs don't realise is a problem until it's too late. Structuring wealth properly once success arrives. Many business owners build companies worth tens of millions, yet their financial structures remain fragmented. Their CPA handles tax returns, their attorney handles legal structures, and their advisor handles investments. But no one is looking at the whole picture. Our guest today, Michael Iskra, focuses specifically on solving that problem. Michael works with high-income, high-net-worth business owners facing significant tax exposure, often starting at $100K in annual liabilities, helping them implement coordinated strategies around tax efficiency, succession planning, executive compensation, and wealth structuring. Michael, welcome to the show. It's great to have you here.
Thank you for inviting me.
I think we'll start off with finding out a bit about your history, your journey into entrepreneurship, and where you got and how you got to where you are today.
Well, I've always had the entrepreneurial spirit. Never really had the appeal to work in large corporate America. Maybe it was fear, but I cut my teeth for a number of years being a hands-on financial manager, controller, CFO level with smaller privately held businesses, turnaround situations, consultant in larger entities as well. And that's where I got my unique insight into structure, observing successful entrepreneurs and seeing a lot of the challenges and seeing the inefficiencies from the business standpoint. Segued into business development about 2008. Like a lot of people that were out there in a really choppy job market, I reinvented myself as a business development person for a cost reduction firm that went into businesses and found savings within the service providers. And that's when I also decided to get a life insurance license, and I thought businesses were a good place for key man, other type things. And what I found is I'm very good at asking a lot of questions and diagnosing things, and that there were a lot of opportunities that business owners were up against, doing extremely well, however, complaining about their tax drag and the things that they couldn't get done, etc. So the focus of my business really became on B2B with business owners specifically, a lot of interface with CFOs and business owners. And that's where I've pulled my team together from there for the last 5 years. It seems to be the hot button topic, and I am a big proponent of that. We are in a low tax environment that will change probably by the next decade. It is inevitable. And when I say that, I focus a lot upon people in the exit phase, meaning 50 to 70 that are selling businesses or divesting themselves of highly appreciated assets that they need some planning if they want to hold on to it. And that's kind of where I fit in. Is everything is about structuring things so that you do not get hammered on capital gains that you don't turn over a highly appreciated IRA to your heirs, which will have to be spent down in 10 years, or if you're so fortunate enough that you're not going to get hacked at 40% when you die.
A lot of advisors come from the investment world. Does your finance and accounting background give you a different and better perspective, do you think?
Can you ask that again? My cat just jumped up on my desk. It's a distraction.
Many advisors come from the investment world. You're obviously finance and accounting as a background. Do you find that gives you a better and different perspective?
Well, I do. Traditional financial advisory is great. They're very, very good at strategies to accumulate wealth, return, and that is the focus. Where I think I'm uniquely qualified is that I do not want to be in that AUM lane. My objective was never, I want to get $1 billion under management and take 1% fees per year. Most traditional financial advisory does very well at the accumulation phase. What I really address is distribution and the legacy phase. People reach the exit point where, okay, how are they going to spend it? How do they take it out tax efficiently? And how do they pass it forward to their heirs and or whomever they would like to benefit from that? So that is where things diverge. That is why I believe that I am more uniquely positioned to address that. I'm not knocking it. I work in conjunction with people's longtime financial advisors. But yeah, that's where the divergence is. It's the it's the distribution and the legacy or the estate planning phase of
Well, when
accumulation.
did you realise the owners were having major tax and structure problems and they were struggling to get them addressed?
Well, I would personally work with some entrepreneurs and prepare their things for the CPA, and I'm looking at all this, and it's a really great thing that you can have a successful company. Well, hypothetically, yeah, you're doing 10 million of revenue, you're compensating yourself maybe 300,000, maxing out your 401k. However, this little thing, if you're an S corp, is your K1 pass through, and there may be a $600,000-$700,000 pass through on the K1 that you don't even realize. You don't take that cash out; it just surprise flows through to your 1040. And I thought, that that's really interesting, and that's what's happened over the last few years. The first thing I get into conversation, how are you structured? S corp, great. Okay, so yeah, it's that tax drag from a successful business and what to do with that, and that's what I found. It comes up again and again and again.
But what made you, look at say 100k tax liabilities of 100k plus as the entry point for you?
Well, mainly because at that point, depending upon the income, how the compensation is, how many levels of deductions in terms of qualified plans there are, you get below that number, and I think there's just not a lot of opportunities available. There are things sometimes with high W-2 earning individuals that do not have any outside business. There are still strategies to help them as well. However, it's just it's about scale, really. There's just greater opportunities when you get beyond the $100,000 level.
Why do many entrepreneurs reach 20 million plus net without proper tax planning or structure? That seems to me to be crazy.
I've been really surprised over the last couple of years how many conversations. It's almost a perception that they don't really think they're worth that much. They can have a business that's doing X, kicking off, $1 million a year. Maybe they got a $200,000-$300,000 tax liability. Then you start to dig a little deeper. Well, I've got a commercial real estate portfolio. That's another 10. And I've got about $7 million in my IRA, and I keep thinking, okay, that's interesting. When that happens, and that's a number of cases I'm working on right now, when you start to hit that level in a qualified account, and a lot of these individuals are never going to need that income or touch it. So you pose the question, well, what are you going to do say you're 55 and, well, it's now 75 for the RMD under the new law. When that 7 million grows to about 12 and you have to take RMDs and they're hitting based upon a calculation of like a 7-figure withdrawal at the prevailing tax rate at that time. And you kind of go, maybe that's something I should look at unwinding. The other aspect of that is that untouched thing, they want to pass it through to their heirs. Well, let's say that grows to 15 million with minimal distributions. They pass away, they give it to the children have to spend it down in 10 years. So that is the whole point being, and my whole premise is that there is a family office approach which is available for the $5 to $20 million net worth range that is just completely underserved. I think what I've found, and we'll probably get to this in the questioning, and it's about everything seems to be in silos. Your CPA handles preparation and compliance. Your financial advisor at JP Morgan's doing very good with the accumulation, maybe overseeing your 401k. You've done some estate planning, putting a living trust in place, but there's more layers that you now need to address, especially if you hit that 20 million mark. I'm completely convinced that the next administration in the United States will reverse the estate tax thing and roll it back to, I don't know, what they were proposing before, maybe 10, 11 million combined for a couple. So it's just very simple to look at the mathematics of what's going to happen. I've seen firsthand what happens when somebody is not adequately prepared, and you have to have what's called a fire sale on assets. A big part of that is planning so that congratulations, you've died with $30 million net worth, you've only got an exemption of 10, and your heirs have to come up with 40% of whatever the excess is of 10, and you don't have the cash sitting around, and you're contingent upon selling a highly appreciated home or something like that. This is what happens.
Does that happen a lot?
Yeah, absolutely happens a lot. And that's the whole, that's a lot of the discussion I have. And there's a misunderstanding about how cash value life insurance works, but I think we'll get to that further in the discussion.
Why does traditional advisory models often fail with business owners?
Go again?
Why does traditional advisory model often fail with business owners?
Well, I think it's a lot of conditioning, probably. I've had some conversations and delved into people that have, let's say, mid 7-figure incomes, net worths of of that and beyond, and they just think that $1 million tax liabilities are the cost of success. They don't like it, but they're conditioned after doing it for 15, 20 years. That's just the way that it is. And a lot of times CPAs have an aversion to looking at what is in the tax code, and it might be viable to change that. But the question really becomes, what's the problem with the financial advisor? Your JP Morgan guy is thinking, well, you should probably do this, you should probably get an inter vivos trust. In terms for protection, so see an estate attorney, maybe they have some affiliates that they work with. It's kind of very cookie cutter. They're not going to. Their idea of tax efficiency is, well, okay, you get to retirement, you'll take RMDs, and we'll do what's called tax harvesting. We'll generate some losses to offset the gains to minimize the tax thing, and we'll put you in some EFTs and some treasuries and munis, etc. But then again, problem with that, it becomes market correlation, and that's the number one thing that's going to happen. If someone has been extremely successful, they're going to reach a point in time where their risk tolerance is less. They've accumulated 20 million, but if something takes a whack of 20 or 30% because it's tied to the equity markets, and this is the problem a lot of times with traditional taking RMDs. What happens if you're taking it in a down market? the next year it has to, come back a certain percentage. It's all that's kind of where the shortfall is. What I deal with and advise is take out some of that uncertainty. I'm not saying shift everything into illiquid or different asset classes, but true diversification. Pull a little bit away from equities. Not a big proponent of bonds because I think they get whipsawed. Put some annuities in with smart structure and look at some alternative investments. Put more certainty into the portfolio, and that's really what's lacking a lot of times is that mitigation of risks. What I do, what I call balance sheet engineering, is just mitigate more risk. I have a whole theory about the proper mix, which I came up with this last year of like 40% equity, 30% annuities, and 30% alternatives, which flies in the face of a lot of the traditional 60-40 discussion about how things should be structured. It's really, and it's going to be important, is to mitigate that risk. You do that with a different approach, which I think is radical. Some people may espouse to it as a little bit more radical approach to income allocation.
Just bear with me a minute.
No worries.
Just one question that I have.
Well, let me ask you this, and this is something that was pointed out to be my marketing thing, is that in a sense sometimes you can't really understand what I do. So I have to really simplify and spell. You understand because you've been around. You understand all the financial terms I'm talking about.
Yeah, no, I understand what you're doing. What I'm interested in knowing is, do you actually advise the advisors?
No, I don't stay in that lane. A lot of times we butt heads about it, but the owners will say, well, look, yeah, I kind of like that idea. I'm going to allocate this to this strategy. They tend to think that they know it all. They don't know anything about proper use of cash value life insurance or annuities, how they work, why. So it's more of a head-butting, but it's a lot of times they've had that relationship a lot longer. However, if I can make a compelling mathematical rationale for why it makes sense to allocate a portion of their resources to this, I often get buy-in, and they'll override their financial advisor. Now, the same token is sometimes people will trust their CPA implicitly. They will tell them, well, that stuff isn't going to work, and that's not worth your time. Well, great. Yet that CPA is what got you to where you are today, which, the definition of insanity, if you're going to keep doing the same things and you're going to keep getting the same results. I wouldn't be having a conversation with them if they weren't tired of writing a huge check at the end of the year. So a lot of times I just sit there with my advisor, say, here's the tax code on this, here's the thing, it's completely viable, it's not going to trigger an audit, and yeah.
So what I'd like to understand is, you've been an accountant, you've done all these jobs, you've sold life insurance. Why is it that these CPAs don't seem to understand what you can see?
I think I'll tell you, I had a really interesting case. I was working with it near year end, and we were showing what was called a tax advantage corporation, which is similar to a charitable trust, and kind of going through the whole mechanics of it, really have to break it down. And he was just so close-minded, like he wasn't willing to wrap his mind around it to think, okay, this thing would be viable, and he wouldn't sign off on it, which was fine. I often get the question, well, why is my CPA not doing this? And I said, well, a lot of them, all they worry about is compliance. Their job is not to consult at the beginning of the year, hey, I think you better do this, I think you better, set up another entity for that side business, and, find some more deductible expenses. Few are into the business of planning. It's all about compliance. And CPAs, quite frankly, don't have the time or the willingness a lot of times to say, hey, maybe I should look into some of these ideas that are getting propagated out there and suggest them to my clients. It would be another income stream for them. There are businesses out there that make a whole model of fractional CFO work that specifically figure out how to create more income streams for CPAs. Well, some of my outreach has been before is, go to CPAs and find their most successful business owner clients and find out if they're doing this. And the introduction route, you always build relationship with CPAs because they're thinking, that would be a good strategy for me to consider.
So that they refer you, do they, a lot of the time? Yeah,
exactly. You can't rely solely upon it. I do work with somebody that has a whole stable of high-income physicians and such. And here's the other thing that I find is that you'll talk with the CPAs, you'll be introduced to one of their clients, and they get absolutely horrible advice. I mean, they have extremely high incomes. They're letting some joker who can't produce a statement of what he's doing with their investable funds. He can't produce a statement for the CPA, and that should be the first red flag that they shouldn't be using him. They have absolutely no structure in place, no retirement accounts, no things that would slow down their tax drag and accumulate their earnings in a tax-efficient environment. So a lot of times, as you'll have highly successful people with no structure going on at all, with improper advisory or lack of it.
Do you physically sit down with the attorney, the CPA, etc., the RIA, etc., coordinate meetings with the owners?
I have done a handful of those. Of course, they're a lot more virtual now. I mean,
well, when I say sit down, virtual or whatever, where you have a unified meeting. Because obviously it's important all to be on the same page at the end of the day.
Well, you have to. You have to a lot of times have those almost the four-way. Simply because, as we probably talked about earlier, everybody's working in silos. And that's been confirmed again and again and again. Is I'll be talking to a gentleman that owns a car dealership, and he's contemplating getting out of Washington State because they've implemented some, new tax law, and he's going to relocate. He's got one CPA firm that specializes in car dealerships. He's got, for that accounting aspect, he's got his own personal CPA to do his personal tax returns, and he's doing his estate planning. And the first question, and this is just the one example, so is everybody talking to each other? And he laughs. Of course not. So how can you have somebody that's engineering their estate planning, maybe a dynasty trust or something like that, if he's not talking with the CPA, the personal CPA? And they're not on the same page, and probably he's got a traditional FIA as well that is managing his accounts. At some point, that's kind of when we come into what a family office does. People have a perception family office is only for the ultra wealthy. It's not necessarily true, but that is the function of a family office, is to integrate all that stuff under one roof. Traditionally, am I going to advise on what they should be investing in private equity businesses? Well, I'd bring somebody else in to do that, but the whole thing is the integration of the accounting, the planning, protection from the legal standpoint, exposure to credit risk or lawsuits, things of that nature. You put it all in one roof, you make it accessible.
Okay, so out of what you do, how much is executive compensation planning versus key person insurance and business continuity planning?
Well, those are two really uniquely different things. Key person is you've got an owner. I'm just saying, this is the conversation they used to have early on. What happens when you decide to leave, and it's boots first, which is great. So then you have squabbling between family members and or maybe key employees you verbally promised things to. You have to have that. Key man is essentially, you want to make sure if something happens to that owner, there's sufficient funding in place to be able to get another person in place, or there could be the top producer, to replace that person, and or get a little breathing room for spouses or what have you of that owner to be able to restructure or figure out what it is they need to do. That's the purpose, which is distinctly different. That's about continuity and protection. It's distinctly different from compensation engineering. So compensation engineering, there's a lot of schools of thought on that. There's something called reasonable compensation, where, okay, S Corp's doing X, and you're going to set the salary at this, and you're going to take the limits for a traditional 401k and profit sharing, and then perhaps you want to put a cash balance plan in as well to further make deductions. However, that's going to be a tax-deferred vehicle. It's not going to be a tax-efficient vehicle, or a very good thing that I like, which is called an executive bonus plan, where you fund a cash value life insurance policy that becomes deductible for the business. It's owned by the individual, and it accumulates tax-free. It has liquidity, and they can actually borrow from the value of that policy for other things that they like to do, and or it can just become a non-taxable income stream at a certain point in retirement if they so choose to. So the income engineering is really, how do you use these things to create deductions within the business now? And there's a whole other layer if you're an S Corp versus a C Corp and how you use that. Sometimes it's just, with S Corps, you're just kind of shifting. You could do one of these things, but you're still having a high W-2, but you're shifting some of that profitability in the business into an efficient vehicle. This is why I'm a big proponent of, at a certain point, C Corps are really good in some of these situations because of the income. They want to create a true deduction, and they want to move that into a tax-efficient vehicle. So that's really what engineering compensation is about. The other wrinkle with that is sometimes what's called the QBI is that there's a whole little calculation if you how you structure the amount of salary and the amount of qualified business income deduction that you get. It becomes mathematically fun to work with it, so you don't put something in place that, well, that's great if it does that, but it wipes out something else on the other side. It's a whole art form. I've just found that the scale of the people that I'm starting to work with is, it's not an abstraction, but it's very real when you can model out, if you do this, compensate yourself at this. If we fund this at X, it will give you this result. It really makes a meaningful shift in what I call the personal balance sheet, because that's really the way that I look at it, is engineering their personal balance sheet, and that's what's happening as a result of all this. Is everything.
When you approach these people, when you approach these entrepreneurs, do they actually understand that they can run like a family office? And
I don't think they
what
do. There are
family
some that
office
are
mindset means?
invariably, they do a lot of research. Well, excuse me, I've had situations where somebody just thought they were getting completely, raped by their CPA firm, everything they charge for simply because of their net worth. But no, I think they probably think it's too costly, and sometimes they may do some research and they'll pull up something in the conversation. Hey, what about this? What about cost segregation when it comes to real estate, or what about all kinds of well, they've become very leery of tax dodges, conservation easements. Never mention that to anybody. they'll have a little bit of knowledge about that, but they don't know how to put it all together. They may ask their CPA about it, and their CPA, that's not good. That's dodgy. That's going to raise audit flags, etc. No, I don't really. It's once again, I think the premise is they would like to have everything in one place. It just hasn't been presented to them. Good CPA team, good financial advisory, etc. So I think it's once again lack of knowledge. So much of what I do is educational. When you come right down to it, it's about educating, challenging bias, and asking, "Hey, have you thought about this?" and posing the question. If you're here now, if you could get from here over to here, what would that do? What would that do for your psyche? How you feel about liquidating the business? How you feel about a lot of things. So a lot of times it's education, and bringing people along to where you present a solution that makes so much compelling sense that they want to do it. But a lot of times, by the time I've talked to them, they want something done yesterday. It's true.
Yeah, but that's human nature, isn't it? How long then does it take generally to get a new client in good shape?
Well, and this is the whole key thing that I've found is that it's not quick. It's not like when I used to. Okay, you find a client and you get the buy-in that you're going to put an indexed universal life strategy in place, and that can come together in a fairly reasonable amount of time. There's a lot slower cycle when you're working with a business owner. I hate to use that word, or taking a whole holistic approach, or an overall view of what they're doing. It really becomes 1, 2, and 3 phases. If I start working at the end of the year, can we find some look back, and then can we start implementing these strategies in the new year? So, a lot of these times are taking 6 to 8 months. 6 to 8 months to come together, and some of them are running into second year because there is a phase 2 that really wasn't available last year that we're getting to now because of some structural changes is now creating the cash flow to be doing another strategy. So it's a lot longer sales cycle from that standpoint.
So how do you deal with that financially? I mean, do you charge on a retainer from?
I do take a nominal retainer, and that's simply to get a commitment level. I found, and I learned this from my brother, who's been in commercial finance for a lot of years. He's an investment banker, and I can have many conversations with somebody, but until they've bought in and have some skin in the game, it's free advice. And what is free advice worth? Nothing. Now, I think it's important to get somebody retained. Not that what I'm doing is completely proprietary, but you have to have the buy-in. So I will get a nominal retainer up front because I spent a lot of time designing this. I have time consulting with my colleagues, and often I have to bring in a heavy hitter consultancy firm or go to CPA firms that I work with, and they will charge separately from what I do. So it's important to have the retainer because I have had instances where I burned a lot of time giving an individual a lot of advice, mapping it out, getting started, and having them do absolutely nothing. And so I never had another conversation. If I did, I would have sent them an invoice for $5,000 for the amount of hours that they.
Do you get a success fee?
I have used that from time to time. I've taken like a 7% of the documented tax savings, which is nominal sometimes. Kicks in a few more $1,000s. A lot of times I'm a little more flexible on that. I'll look at the situation, does it make sense? But yeah, I will take a success fee.
You've been focusing on building authority and thought leadership How do you go about doing that? You talk about identifying a very clear client avatar. Why is that important?
Well, if you do, here's the whole thing that I learned along the way. It's tantamount to marketing. You have to know your client avatar. I have a colleague that I met this last year, and he did some great YouTube content. Well, I would say great, but I looked at it and I thought, does he understand his client avatar? He's throwing out a lot of stuff. But yeah, if you don't know your client avatar, it's like anything. I don't want to be all over YouTube with catchy soundbite stuff, which is simply a funnel. I don't want a
Yeah.
mass funnel to get a bunch of looky-loos. I mean, I've become very, very clear that I understand my niche, what I'm looking for in terms of the parameters I've set: $1 million incomes, minimum $100,000 tax liabilities, net worths of five to 10 million. Simply because what I've found is there's a mindset in an entrepreneur when they reach a certain level. They have a certain mindset, and a certain sophistication, and a certain intelligence, and you can't talk down to them. I mean, you can't insult their intelligence because they got there, and you can't use salesy bullshit with them because they see through it. So if you understand that they've become successful, but they still think that they need some guidance, I'm able to identify what the pain points really are, and that's why I refuse to do mass generational thing, because I'm not trying to take on 100 new clients each year and churn them out. It's just not what I want to do.
So, what is your optimal amount of clients a year?
With what I'm doing, and I found over the last year, I mean, it's adequately, 10 to 15 per year is really helpful. Mainly because I uncover that a lot of times the revenue that can be generated is anywhere from 100 to 250,000, depending on what we do in this situation. I'd rather have a manageable amount versus a volume. Simply because I offload a lot of tasks, but yeah, there reaches a point where I don't want to be stretched so thin that I'm underserving somebody that I'm working with. If that
How
makes
do
sense.
you, sorry, how do you differentiate yourself in a crowded advisory market? Like, what is your opening line? How do you sell yourself initially?
Well, the key thing is to be in this marketplace, especially this niche. Is you have to be very clear about who you are and what you do. Uh, if you're really relying upon the certifications you have, okay, that's great. Um, if you want to have a bunch of letters after your name, that's great. It helps for authority. Um, Differentiator, I think, really is that when people talk to me, well, they're finding out that stuff was not covered. That's not the discussion they've had with the CPA, the financial advisor, their estate planning, etc. So why I'm differentiating myself is simply knowledge, experience, but also being very clear about I'm not a CPA. I rely upon CPAs to sign off on something that I'm suggesting. Not a registered advisor. May at some time decide to get a 65 if I really want to do that, but I'm not really interested in managing assets per se. I can't pass myself off as an estate attorney. My wife is. I can bring her in to sign off on things or put things together for me. So the key thing is to be very clear about what I am and what I don't do. So what I really do is project management and or a sports term, a quarterback. It really is marshaling all these particular things. And the efficacy is really the results when I can say I helped this person do X, Y, and Z. If you've done it a few times, you start to develop more authority. And when it really comes down to, and this is the best advice I got from my mentor, who was a centimillionaire, well, still is, but he just kind of said, at the end of the day, Michael, you're selling Michael Iskra. And it's like, you know, POM Unlimited, POM Unlimited is Michael Iskra. That is the brand. And that is the brand is to sort of align myself similar to like Bernstein or what USB or these other things are doing on a larger scale for a specific market that they like. So yeah, really, when it really comes down to is that they're buying in and trusting Michael Iskra, that he's got a unique insight into things and he can pull things together that makes sense.
So what would Michael Iskra advise entrepreneurs now to start thinking about 5 to 10 years earlier than they currently do?
Yeah, it's always the big word, tax. Figure out how to. The name of the game for a lot of years has been deferral. You know, take a short-term advantage of your deduction now because you're going to accumulate Y, so it won't matter. Think about tax efficiency now, because, as I said earlier in our discussion, it's historically lowest rates. They will not continue. There are demographic shifts in this country that we're going to make it inevitable that we will need to increase tax rates. And it's funny because I could see firsthand when you start to run the numbers of you get successful at a certain level, and if you're giving half of it away, not to say that it disincentivizes you, but it does piss some people off. Let's put it that way.
Well, you should work in the UK where it's a lot higher.
Yes, exactly. It's
You're totally disincentivized. Just a quick one before we wrap up.
Sure.
If you could change one thing about how successful entrepreneurs manage their wealth and financial planning, what would it be?
I think it's back to what we discussed about diversification. Stick to what you know. If you love equities and love that ride, great. If you like bonds, great. If you like real estate, great. If you want a little bit more safety and certainty, that's really where I come in. Really, what I think that I deal with is you don't make guarantees, but the things that I advise provide a degree of certainty about what's going to happen, because you can play it really safe. You can park everything in cash. That's not going to be successful, and there are other people they don't want to make a decision. But with inflation rates, everything's eroded. But you can put some certainty in with certain vehicles in terms of nice, favorable returns. You can find tax efficiency, and the greatest thing out there is Section 7702 of the Internal Revenue Service Code, which pertains to cash value life insurance. It is the perfect risk transfer vehicle that everyone should take advantage of.
Very cool. So, Michael, it's been a really good chat. I've learned a lot about the tax system and how to manage money. If I ever get to 20 million, I'll be knocking on your door. For entrepreneurs listening, where can they get hold of you, and where can they find out more about you, and obviously, access your services?
Well, I have a website which I'm sure you can propagate, which is www.pomunlimited.com. POM Unlimited, the entire word spelled out.
You're on LinkedIn too?
I'm on LinkedIn as well.
Cool. All right, Michael. Well, I think it's been a really good podcast. I hope you've enjoyed being my guest. I'm sure the listeners will learn a lot from this today. We'll be back in the next couple of days with another episode of Wise Tech for Wise Money. You all know where you can find Michael now for his superb services. Maybe he'll take you on if you've got slightly less than 20 mil. But it's been a great podcast, and I want to say thank you, Michael, for being on board.
It's been my pleasure.
Thank you very much.
Thank you. Have a great rest of the day.